Section 15.2, we're now moving on to bonds. A bond is a type of loan to the issuer to raise money for a company or a municipality. The investor or bondholder will be paid a specified rate of interest each year and the entire value of the bond at maturity. Your face value or par value is the original value of the bond, usually $1,000. Maturity date, the date at which the face value of the bond is paid to the bondholder. Junk bonds are high-risk bonds that are usually from companies in bankruptcy or in financial difficulty. Investment-grade bonds have a high probability of being paid with few speculative risks. Corporate bonds are issued by businesses. Municipal bonds by local state governments, treasury bonds by the federal government, and then coupon bonds require the investor to submit a coupon at a specified time to receive interest. Then we have registered bonds, convertible bonds, which convert to stock. Callable bonds can be repurchased by the company before the maturity date. Bond market is a structure for buying and selling bonds, just like we have the stock market. Premium bond, it sells for more than its face value. A discount bond sells for less than the face value. So reading a bond listing, a bond has a face value, a date of repayment, and a fixed rate of interest per year. So like stocks, bond prices fluctuate according to market conditions. Because a bond obligates the company to future repayment, public judgment of the company's future will affect sales of a bond. So here's a bond listing. Again, looks similar to our stock market. We have the issuer name, so the company name, their symbol, and then their coupon. Which is the annual interest rate expressed as a % of the face value. Next, we have the maturity rate, which gives the month and year when the bond will mature. And then last is the ratings, for ratings for Moody's, S&P, and Fitch. These are the ones whenever they talk about, again, on the news, a lot of times you hear talk about the S&P and how the S&P is doing. These provide the issuer's bond rating for 3 primary rating services. The rating services that tell how the company's doing. So you do want to be, careful with some of them. Obviously, some are better than others. But it's the Moody's, S&P, and Fitch. You want to make sure that they're all right around the same. They should all be right around because they do have their own rating system. So if, 1 or 2 is giving them something very different than the other ones, you may want to be careful. Then similar to our stocks, we have the high and the low for that trading day, and then the last or the closing price for that bond, which again is a % of face value. Next, we have the change from the previous day's closing. Again, positive means it increase, negative means it decrease. And then the % yield. So it gives the yield to maturity, which is the annual rate of return over the life of the bond. So let's locate the % of 1,000 that the bond was selling for at the close of the day. So we go to column 8, which is the last, multiply the decimal equivalent of the % by 1,000, and then round to the nearest cent. So now let's find the closing price. They gave us a symbol for our bond, so we come over here to the symbols column and we locate our Citigroup. So next we want to come over here to Citigroup, look at our last. Take that 117 and 733 thousandths, that's a %. So we're going to take that times 1,000. That the closing price is $1,177.33. A yield is a measure of the profitability of the investment. Your yield to maturity measures the profitability over the life of the investment. The current bond yield or average bond is the annual interest per bond. So let's calculate the current price of a bond. Locate the stated interest rate or coupon in column 3. Multiply that interest by that $1,000 again. But now we want to find the current bond yield. So we're going to take the stated interest decimal by the 1,000 divided by the current price of bond and multiply it by a %. So let's calculate the current bond for Kraft. So we'll come over here to our Kraft Foods, come to our coupon, take the percent, convert it into a decimal, times it by the $1,000, divide by our $1,034.11, times it by our percent. So our current yield is 5 198,000%. Section 3, mutual fund listings, and then return on investment. Mutual funds are similar to our bond and our stock. We find the appropriate fund family in the first column, find the appropriate fund named, which is the indented entry. Next we can don't know why I came through twice. Okay, next we'll find the symbol. Then we have our NAV, which is the net assessed value. Column 4 is our change. It's 1 day total change. So again, that's the plus or minus. Did we increase from the previous day or did we decrease? Your percent yield return to date. And then column 6 is the 3-year percent change. That's important to see how well your how well your fund has been doing. Because you want to be careful. A 3-year change of minus 14.3. A portfolio is a collection of different types of investments. Mutual fund or investment trust is a collection of stocks, bonds, and other securities that is managed by a mutual fund company. Your NAV or net assessed value is the value of one share of a fund. This value fluctuates just as the value of stocks and bonds fluctuate. So let's find the current price per share. What is the price per share yesterday? So we come over here, find our symbol, AFMMX. We want to know what's the current price for the share and what is the price per share from yesterday. So our current price per share is our net assessed value, and then our change was plus 0.09, which means that we are up the 9%. We were up 9 cents from the day before. So in order to find yesterday's value, we would subtract. How to find the NAV at the beginning of the year? Divide the current NAV by the sum of 100% plus your year-to-date percent return, and then round to the nearest cent. So look at our table again. We take our NAV, divide it by the 100% plus your year-to-date percent, which is over here, so don't forget to convert that into a decimal. Put that into your calculator, round to the nearest cent, so the beginning of the year NAV is $7.59. Calculate return on investment. We want to find a gain or a loss in your investment. Take your proceeds plus any additions, and don't forget to subtract your total cost. To calculate the return on investment, your ROI, take your total gain or loss and divide by the cost of investment. So let's calculate our return on investment for 1,000 shares of a mutual fund purchased at a price of $8.16, sold with a net assessed value of $9.36 that paid a dividend of 27 cents per share. So we're going to start with our total proceeds and take the 1,000 shares, and it was sold at our NAV, so that's what we multiply by, the $9.36. So what we got from our shares were $9,360. We then have to take into account any additions. We did receive 27 cents dividend per share, so we received a total of $270 dividends. And then we want to subtract our original cost. So original cost of the 1,000 shares times what we purchased them for, which was $8.16, which was $8,160. So we take our total proceeds, add your additions, subtract your total costs, and we came out with a gain of $1,470. So to calculate our rate on return, take your gain or loss and divide by your total costs. So we made 18 1/100% on our return.